Hello, everyone. Welcome to the latest edition of CB3 One-on-One. And tonight is very, very special. They all are, but this one is incredibly special because this man, Paul Jiganti, is the one who introduced me to the financial markets in the very early 1990s. I was writing music for TV commercials at the time, very much thinking I was going to spend the rest of my life in music. But that radically changed when Paul came over one day. He was my next door neighbor in a suburban city in Chicago and said, I'd like you to come down to the exchange. You want to just see what I do? And I actually rebuffed him a couple times, but the third time when he asked, I went down there and we talk about that day in the interview. But I hope that you'll enjoy this. The reason we're doing this is so that you can see that the stock market is not just the stock market. There are other components of it, components called derivatives. And you're going to hear about that in this interview, specifically the options market. There's also the futures market, the foreign exchange market, the credit default swap market, all derivatives of the primary products of stocks and bonds. But Paul's specialty is options trading. And it's a fascinating story, and I hope you enjoy it. Here we go, the interview with Paul Jiganti. Welcome, Paul, to CB3 Live. It is an incredible honor to connect with you after all these years, the man who introduced me to the financial markets. Thank you for being here with us tonight.
Thrilled to be here. Thanks for having me on. You've done way more with this than just about anybody I know, so it's going to be fun to listen to this.
Well, I've put together a living, not at all what you did, but you got me so energized about the markets. Here I am on my way to 71, and I still get up every day, just can't wait to see what's happening in the markets. So for those of you that are listening, Paul is definitely one of the most well-known people in Chicago in this industry. But what we want to do is not gee whiz you guys with terms, okay? We're going to have a lot of supers, so look down here in the footer of the video, and we're going to explain the terms as we come up with them or as we say them. But it's important that you understand that options may have a reputation of being, speculative, but really they play an incredibly important function in the economic system, and that's what we're going to cover. So why don't we start at the beginning? So you have a degree from San Diego State in economics. And I'm wondering, in a chicken and egg situation, did you go there knowing you wanted to be a pit trader and got training for it? Or did you go there, learn about economics and decide when you came back to Chicago, well, I'm in the heart of the pit traders of the world. Maybe that's what I should do. Which was first for you?
Oh, see, I went there. I went to the University of San Diego to become a doctor and realized that though I was always a mediocre student, when I got into anything to do with biology and that sort of memorization, it wasn't there for me. So I pivoted to business, which actually I had a lot more interest in, and ended up with an economics degree because it fit really where my interests lay.
Okay. Go ahead.
And then, really in the middle of college, I have an older brother that was a pit trader in the commodities markets in Chicago at the time. And he asked if I didn't have a summer job that I really wanted to do. And he set me up to be a runner for a couple of summers down on the Board of Trade floor. And I tell you, the first time I heard the opening bell and saw the activity, I was hooked. And every day that hooking got really worse and worse, and I never gave it up.
Well, the fascinating thing is that you and I share a commonality there, because I remember standing next to you after we went through security. Folks, you've got to remember, there was no internet. Netscape was 3 years away, okay? People that had modems couldn't even do anything with them. So there were fax machines. But when Paul talks about runners, and we're going to get more into this, this was really the heyday of the markets when there was not all the crazy automation and computer trading that there is now. So what did you learn then at school that translated to being a better pit trader, or did you really just have to figure it out on your own? And your older brother you mentioned, I think, is Mark, right?
Yes.
Okay,
Yeah.
yeah, because we have a viewer that saw my preview for the show and said, "Is this Mark's brother?" Because I stood next to him in the pit, so I think I
Yeah.
sent you his name. I don't know if you know who the
Yeah.
guy is, but
I did not recognize the name, but
well, he'll be watching the show, I'm sure. So, but anyway, go ahead and delve into that, and then we'll transition away from college. But what were you able to take from those 4 years once your brother gave you that opportunity?
it's just, I think it was just the vastness of what's out there in the marketplace. Meaning, we really didn't cover markets. San Diego's 2,000 miles from Chicago. And without the internet and all of those things, Trading Places I don't think it had been released yet. So it was not not something that anyone knew about. So once you go down there, like going down there, I would say that the skill that I brought to it was probably discipline and humility. I knew I was an average student, and I knew that I had discipline from playing different sports. That you are never better than everybody, and the collective knows more than you do. I think was the real thing that I took away from my education.
Got it. So it's interesting. You mentioned Eddie Murphy. Well, you didn't say Eddie Murphy, but you said Trading Places. That's how long ago this was. So if you haven't seen the movie Trading Places, folks, rent it sometime, or you don't rent it anymore. You just go to Netflix and get it. But it actually takes place in New York, in the what used to be the New York Board of Trade before it was the ICE, et cetera, et cetera. But it's orange juice pits, and it's kind of dorky, truthfully. But at the time, all of us were cheering because it's like, yeah, this is us. This is what we do. So, um, anyway, that was something that was really cool. So, did you get any additional training? So when you got here, and of course you introduced me to this, and then I immediately started. There was no internet, but you rang the phone at the Board of Trade. Do you have anything that'll teach me how to trade options? And yeah, we have a course. You must have pursued some of that, I would think, or no?
It's funny because when I started in 1985 on the trading floor full time, I got a job. I had the greatest mentors in the planet. It was a friend of my other older brothers. His name is Rob Main. Wonderful guy. Still keep in touch. Taught me more discipline than I had, and more about the truth, the guts part of trading. And, with the little pieces of his advice, meaning you're not, even if you're certain about something, you're not betting the farm. You are going to stay disciplined. You've got, the most important thing is to be able to come back and trade the next day. And when I,
Absolutely. Yeah. The markets
and,
will take care of themselves and the profits will take care of themselves. But if you're not managing risk, you're going to blow out. Yeah.
mhm. And it happened to a lot of people. And now the other thing was integrity. On the trading floor, there was nothing that once you did something that was illegal, or we'd call it slimy, or you were done. You people would you could physically say, "I didn't hear you." That was the answer to, I should have been on that trade. No, you weren't. I never heard your voice. And that was what the brokers would say when they would come in, if you had unethically done something unethical. And that was a pretty common response, and it ended your career. And there's no coming back.
It
So
sounds like you're describing being blackballed, sort of like, the McCarthy era in Hollywood, but the equivalent of that for trading.
right, and you had to have, it couldn't be some minor infraction, but the minor infractions could add up. So you would just say, yeah, I don't trade with him. And generally it was a him. It was 99% men. And so Rob would say to me, if you do any of that, I'm throwing you out of the office. And if you do any of those types of things, and it really stuck with me, because then immediately you do see people that made the bad decisions, and how it affects their career. And I was the son of a judge. There's not a lot of times that I was ever going to go on that side of the line, anyhow. And it really stuck with me, and there's a lot of different things about trading. But the one thing he taught me, well, you have to know, digress a bit. The only reason, the most important thing in pit trading in those days, and I'm sure it still holds, is your reaction time. The first person to react to what is your market on X option series, you would give a bid and an bid and an ask,
Sure.
and the first person to respond had the choice of doing part of the order, the whole order, and at the best price. So it was really important to be able to respond quickly. Me being 23, being somewhat of an athlete, and Rob was 26 and a really good athlete. We'd run together in the afternoons. Some when I very first started trading, and I said, "How did you become so fast?" He was known as being the fastest guy. He goes, "My secret is," and now I'm giving it to the world, but it's a little too late for us. Is to when he runs, he would count to $1 by sixteenths of a dollar. So he'd say teeny, teeny was a sixteenth, teeny
Right.
eighth, three steenths, quarter, five steenths, three eighths, seven steenths, half, nine steenths, five eighths, 11 steenths, three quarters, 13 steenths, seven eighths, 15 steenths a buck. And then you would challenge yourself on adding them and subtracting from each other on those things. So you would come up with the price first every time. And, you had to be interested and want to make that trade and all those things, but it got you the choice to make every trade.
Right.
And Rob's training got me, if not the fastest. I think I have a brother-in-law that I stood next to for many, many years. I think he would challenge me if I ever said I was the fastest in the pit, because I think he would think he was the fastest in the pit, and a few other folks would say that too. But it was, being fast was such a gift.
So
And
I didn't realize that if you're first, you can actually take it because they're going to say, we need a bid on 200. We need a bid
Mhm.
offer on 200. They could take all of it. They don't need to leave any of it for anybody else. They get the first
Right.
choice because they're making the market. Now, what Paul just said was he used the word steenth, which is short for a 16th, which is the way that options used to be priced. And of course, this is going to get into the weeds. We're going to do that in a later segment. But the market changed dramatically when they went from 16ths to penny wide in stocks like Apple and Nvidia, obviously. But what you just described was mental training for acuity to be able to respond quickly. And I would think that that's just good for your mental health in
Hmm.
addition to making you a good trader, right?
Probably.
Can you walk through then a typical day in the 80s? And then I think you left in about the mid 90s or late 90s from the floor.
No, I actually stayed on the floor until about 2005.
Okay.
And
Well, let's
so,
just talk about the difference between the 80s because technology was coming along. I mean, we started to have program trading. Globex was a big
Mhm.
deal. Nighttime trading in the bonds. I mean, there's all kinds of things, right? So just talk about the three different decades in which you traded and how it was different from each other.
Yeah. So in the 80s, it was almost no electronics at all. And even the theoretical values that we all uh, used to print up sheets and saying, "Oh, the volatility is this, and the stock price is this. What are the theoretical values for each one of these option series, and how do you tie them together?" And you would print those once a day, and then the volatility would change throughout. As we see now, it
Sure.
happens way more dynamically, but it would happen throughout the day. And when markets are three-eighths of a dollar wide, you can't really judge the volatility changes so much. But when they're a penny or two pennies wide, you can today see the volatility curve. Thinkorswim will, or many different platforms. Will give you an exact volatility down to the hundredths of a volatility point. So it will, that clearly wasn't there then. We were very seat of your pants, trying to figure things out. Had a lot of tricks to not have to have too much paper on you, but and kill too many trees.
Right.
That was it. Yeah,
But you had to have that. You had to sit in those days, the traders had paper in their hands to try to take in. You couldn't even take the time to work a calculator. Back then you had a Hewlett Packard calculator or something, because that would defeat the whole point of being the first one. You'd be the fifth one to offer and it'd be too late. So
yes,
then the
and
90s, what happened in the,
well, and then the '90s, it became more. There were some people with computer screens that would be able to price things a little better, but you're right about being faster. We would, you know, the old folks, that I was becoming then would make fun of the kids with the computers and say, "Oh yeah, good luck with that. You're never getting on a trade." Then that quickly evolved into watching ISE was the first options exchange right around year 2000 that came in and kind of messed up the entire options market. There was in the Hewlett Packard or IBM would only trade on one floor, and there was three main floors at that point, and if it, or maybe four, if you wanted to trade that stock, you had to go to that other exchange. The Justice Department thought that was not enough competition between the exchanges, and we ended up having all stocks listed on all exchanges as we do today.
right?
And the number of exchanges went from 4 to I think 18 right now.
Yeah.
And so that's quite a difference. So computing power, then became much more important. And I worked for Susquehanna at the time. We had somebody in every pit trading Microsoft for those, between 2000 and 2005 or six.
Sure.
And then suddenly we had a computer system that became dynamic enough where you really didn't need somebody in every floor. And we ended up, cutting down the number of traders that were needed for this for trading equity options by about 80%. And that was a real big change. And, honestly, as I described, my quick reaction time and being honest, those are two things that don't really translate to a computer screen. And then you find out if you're a good gambler, if you're a good, position taker. And I went from being, top probably 10% or 20% of the people to being completely in the middle. And I just wasn't that great at it. And I knew it. I wasn't delusional. And I saw my skills becoming less useful and less special, really. And I'm ahead of myself probably on this.
How did you navigate the physicalness and the volume of noise? I mean, that's part of what I think you're describing, is that you're able to sense the emotion. People can say it's all based on theoreticals, and you've talked about that. But when the market's crashing on October 19th, a lot of that just goes out the window because you can't calculate volatility fast enough. Yeah. Because of things, gamma, we'll get into this later on, because things that were way out of the money, it's like, oh, now all of a sudden, 30 minutes ago, that was way out of the money. Now it's at the money.
Yeah.
Right. So understanding that emotionalness and the physicalness of getting in front of people, more specifically in the OAX pit, which another pit that's gone, it's all SPX now. Yeah. But what was that like? I mean, athlete really had to help you there, right? Because there were a bunch of athletes that trade.
We recruited a lot of athletes, and most of the firms recruited athletes. I'm 5'9", so I'm clearly not very tall, but the average people down there were well taller than me. And you had physical things that you could do. You could have a voice that stuck out. Mine, for some reason, could stick out. And the rest is just luck. It's luck that you're fast enough. It's luck. But then, places, times like October 19th and those days, it just went back to what Rob taught me. You got to be back tomorrow. You better have extra puts in your account every day. And,
and by that, you mean long puts.
Yes, long
For
puts.
sure.
And so, as you know, when you're trading on basically on huge margin, as a trader, you had much better,
Massive.
massive, uh, uh, massive leeway to take risk. You had to have the tails and the ends of the curves taken care
Sure.
of because you didn't want to be carried out by some, you're trading a stock that could never get taken over, and all of a sudden it got taken over. And
Well,
and
you got the famous Lucent story. I had people that came into my, retirement business, very different from what you were doing. And they're saying, yeah, I have Lucent stock. I said, what's it worth? $3. What'd you do when it was 205? They told me to hold it, and so those had to be really big pits for the 2 years it took for that stock to plummet as AT&T was,
yeah,
diversifying. Just
yeah,
crazy stuff.
yeah, and there's tons of stories, and I'm sure I can remember some that were not so great for me, and some that worked out well, and it's during the crash in '87, I was fortunate enough to still be associated with Rob, though I had traded for him for a year, and I'll put dollars on this that makes it really kind of interesting to us 35 years later, which is he gave me $25,000 to start trading with, and I was on the floor trading it with $25,000 in my account. That doesn't seem like a lot of money to me today, from the swings that everyone seems to take on these in trading. And once I made enough money trading for him, he said, "I didn't do this to make money. I want you to make money. This is all." So he said, "You can keep the 25 grand. You can give it back to me because I had made enough to stake myself." And he goes, "Whenever you're done, uh, we're good." And you know,
Wow.
I and he was incredibly generous and left me out there to do it. So um, no one else in the world had that had that kind of
Let's
mentorship.
talk a little bit about the advantage because, again, people that are watching this don't have any idea. You open a margin account, it allows you to buy 50% more stock, right? You get a 50%, maybe you get 60. If you have portfolio margin, like a lot of us trade with now, that's 15%. So it's a lot greater leverage of the money. But when you're trading on the floor, there was no margin or portfolio margin. You just had haircut. And can
Right.
you describe that a little bit and why that you had to have that advantage? Because again, they could do that because they know you're playing both sides of the market. You're not speculating. You're covering
Yeah.
with little. Go ahead.
Yeah. I mean, the haircut was just a different way to calculate it. And honestly, I don't even remember how it was calculated, though at the time I'm sure I did. Uh, but the risk managers would look at your account and say, uh, down 10%, you're losing too much money, or up 20%, you're going to get blown out. Neither one of these things are okay. And the risk managers were really important to the clearing firms, and they kept an eye on those things. I had Rob sitting over my shoulder, beating into me that you're never going to get blown out, whatever stock price comes up. So during the crash of '87, we used to make up trading cards that would say, "Oh, on all these strikes, these are my positions," and then you would, erase and put in the next. If you bought something or sold something, you keep track of it on your card. But I would know what my net put position was and how many puts I was long, but I would only keep it to something that was rational. And when the market gets irrational, I mean, I would keep it in total because
Sure.
I kept discipline, but everything beyond the end of my card was always long because it was never going to happen, and those were worthless. And so in the crash of '87, those worthless things became a lot of money. And
I
it,
would say that translated into 2008 and nine, which we'll get to in a minute. But
yeah,
it's just it's what Nissam Taleb says is a black swan event. How many black
hmm
swans do you see in the park? One every 10 years, but it happens. It's an extreme outlier, and you're preparing for that day so that they don't, as you say, carry you off on a stretcher.
exactly,
Yeah,
exactly. So again, give Rob some real credit for that.
that's awesome.
So
We covered pit trading to screen trading, but maybe just a little bit more. So you transitioned 2005. You told me earlier. I think I'm back on camera
mhm.
here. Um, but you ended up with Susquehanna. You were on the floor the whole time with Susquehanna. Were you
Yeah.
managing people or?
So, my career arc went from working, working for, clerking for Rob Main, trading for him for a year, traded for myself from early 1987 till 90, I think it was 91. And United Airlines, not the stock was getting taken over. There was some, and the deal never went through. It kind of crashed the market. A bunch of things happened, and then the options volume just imploded. There was really no way to make much of a living unless you were a better trader than me, apparently. But I had two little kids, and I hadn't made money in a year. And I went, and the guy standing next to me in the trading pit was a new partner at Susquehanna, which was only a few years old.
Right.
And I turned to him, asked him what I should do. He said, I said, you guys ever hiring? Ends up that they took me on within a week. I was in their training class in Philadelphia for 3 months, leaving my young family in Chicago. And
Carol was a trooper. Had we
Carol,
transitioned from 16s to cents at that point? Was that one of the
no, so
reasons?
that was 91. So then I stayed. I went to Susquehanna. I had pit trading experience, but I didn't know how they traded, and as I found out, I didn't know anything about gambling, and I say gambling because Susquehanna treats trading more like a poker game, and again, it's their discipline. It's incredibly successful, and a lot of people follow that mantra or that playbook when they're trading.
Can we expand on that? I know we've got it in our
Yeah.
script to do it later, but you mentioned Vegas and the similarities, which of course that's get people thinking about, oh, it's just gambling. See, I told you it's just gambling. But Vegas is managing odds. They can't stay in business and have these gargantuan casinos that we all have seen if we've been there, unless they are managing odds as firmly and rigidly and prudently as Allstate and State
Mhm.
Farm. Would that be fair to say?
Completely, completely
So
fair. And
maybe expand on that just a little bit.
so, not to get too far in front of what Susquehanna does, I don't work for them anymore. So, and though I have immense respect and learned really so much about from trading to how to make life decisions through their training. So they they look at every situation like it's a bet. Am I going to make it to work today? I bet you, like you're saying in your head, you don't think about it, but I bet I'm going to get there. And I'm going to the train's going to get in and I'm going to make it to work on
Sure.
time.
Like
And
actuary. I mean, it's an actuarial approach, right?
and it's the same approach. And then where it gets interesting is when you, you know, when you get into a situation where you think you have the best of it. You have information that the rest of the market doesn't have, or you're reading the information differently. And then it's how certain are you? You look at your past work, and you see, oh, I've been pretty good once I've seen these things line up. And then it's how big do you bet, and and how do you take that going forward, and how do you get out of this, and what's your plan to get out? And those are the things that Susquehanna taught extremely well. And what you mentioned earlier about how there was no internet, and so the information flow is incredibly slow to get back to the end user. Today, end user on
Yeah.
a retail account,
Think
you
or
have
swim.
access. You are just as powerful as a lot of trading firms. They may be fractions of a second faster, so they're going to get to certain trades that you can't even see, but you have tools and you get to see the movements as everyone else does.
So
They
I'm
just have
working with LiveVol Pro. I'm sure you know that with SIBO, and it is astonishing the data that is in there
Mhm.
to give you an edge. I mean, it's astounding. Nothing like that when you started.
Yeah, right. And so what we would do is think about the stock trading in one pit, in one exchange, and that's where all the options trades went. So all the information is in that pit. So when you turn and you see, oh my gosh, there's a, what probably, today we'd call it a hedge fund or uh, is in here and they're buying calls like there's no tomorrow. There is something going on. This is unusual activity. And so you would read the unusual activity, and now it's public information because it's in a pit, but but really there's not that many people that have it, and so you have the
Right.
advantage if there are other orders sitting around, or if you're just going to buy the stock, or if you're going to do something like that, and you have to judge. Do they
What
know
you
something?
just discussed is they made it public by mentioning it, but they may not have had public information that got them into that pit. They might have had inside information
Hmm.
to buy 1,000 lots in, ATM calls. But once they're doing that, it becomes public for you. So there's no, I mean, this is a thing that you guys have read about the Martha Stewart and other
Hmm.
people that have, and for that matter, Congress, but I digress. They can make trades without having to, keep public information off the street. But this sort of thing is something you wrestled with in the pits all the time.
Yeah.
What's public information and what's private?
Well, and if it comes to the pit, it's public information, so
Sure.
you are able to act on it as much as you want. Um, and when you have deep pockets, and now all the trading firms have deep pockets, but at the time there weren't very many. So the Susquehanna group had uh, quite the advantage, and we were enabled to really take on risk and position ourselves to, one, not get killed by the people you're selling calls to
Yeah.
because you're
Right.
obligated to make a market, and two, as it was position yourself to profit from something that is now public information that looks odd.
An outlier, so to speak. So let's get into the weeds. And again, those of you that are watching, you've been watching my shows a long time. This is going to be the weediest section I've ever done, but I don't often have a genius, bona fide genius options trader on my show. All right. So Paul and I are going to kind of get into the weeds. Look down below. Josh is going to put supers on the screen here so you can understand what we're talking about and why are we doing this. It's not to gee whiz you. I said this up front. It's because I want you to understand the importance of what happened in Chicago, the futures, the options trading here that hedges what happens in New York and London and Tokyo. And if you're not from Chicago, that's fine, but Paul and I are. And so we're near and dear to this. So let's talk about this. An option, in its simplest terms, gives the buyer the right, but not the obligation, to purchase an option at a certain strike. And an option has a bunch of different components to it. So if you're long a stock, you own a stock, you want it to go where, folks? Infinity. If you are short a stock, you've sold it short, where do you want it to go? Only one number works, 0. Okay. But in an option, and Paul's going to expand on this, you might be bullish in August next month, bearish in September, and bullish in October because of various, news announcements or earnings reports. And all of that can be achieved with options. That's
Mm-hmm.
just what blew me away from back then. Can you elaborate that a little bit?
Yeah,
And let's just talk about it.
you can tailor your opinion into just about anything you want. It's from. I think that these earnings announcements are going to be incredibly, if incredibly soft. I'm going to buy put options on this stock, but I think and so you can spread options against each other, buy one and sell another, and so you're not that exposed. And so there's really anything um, that you can imagine. It could be you could map out an option strategy uh, that will win to it.
There's
And
no other instrument in the financial world, in my opinion, that equals an option. whether it's a futures option, a Forex option, or we've been talking about equities options, obviously. So here's the next thing, and I want you to elaborate on this. An option has a lifetime. If you buy IBM, the chances are you could have bought it obviously 100 years ago had you been alive, and IBM hopes they're going to be around in 100 years, although Eastman Kodak hoped the same thing, and Lucent and a bunch of others, right? Point being that an option has a limited lifetime, and during its lifetime, it has 5 key components, and there are more, but these are the 5 key: delta, gamma, vega, theta, and rho. Why don't you define those for us? Because that shapes the nature of the option over time and gives it its uniqueness.
So delta is its sensitivity to the move in an underlying, whether it's stock or future or whatever the option is. So let's use a stock. If the at the money option, meaning the stock's trading $45, I want to own the stock at if it's over $45, I will buy an option to own that at 45 on the 45 strike. All these terms are
they're going to be super. We're going to do it for them, Paul.
Okay, and so you can buy that option, but you may get better leverage because you're in your head. You say the stock's going to 60, and so you can buy a lot more 50 strike options, meaning by the end of September, is it going to go up above 50? You could buy an option that you have the right to buy that stock at 50. They're going to be cheaper than the ones at 45 because those are way more sensitive to the stock price, and you have that $5 head start.
Yeah, we should explain to them that out of the money options don't respond as quickly as at the money options until they become at the money options, and they do if the underlying moves. And that's what I mean about this living, breathing thing. So as we get nearer expiration, gamma comes into it. Let's talk about that.
Yeah. So options the delta sensitivity to the underlying move. Gamma is how much that sensitivity changes over a period of time. So and I think it's been a long time since I've done options theories. So I think it's over the next one increment, meaning dollar. I think it's a dollar move, but I think it actually changed. It's a continuous curve, but it's to judge the change of the delta over time. So 40, if the stock's at 45 and you're talking about 45 strike, it's going to have generally roughly a 50 delta. If you're, and the 50 strike is going to have, depending on the other components that we'll be talking about, will have something lower than a 50 delta. It's going to move less than 50% of the underlying price. And so there's a curve to it.
Yeah, exactly. A skew. So in addition to that, folks, if that's not enough, you can go into an options pit or on a screen today, and it can be very quiet like it was today. We're shooting this on July 29th. But it can be like April 2nd or April 5th, just a few months ago, and that same option can have a lot more volatility to it because the underlying is volatile, and that affects the vega, Paul.
Vega is the volatility component. It's how much you expect that stock to be bouncing around, really. And if you're expecting quite a bit of bouncing around, that at the money option is going to have a lot of value because it's going to stop you from having to put out $45 to buy the stock. You could put out $1 or, for the next month to actually get the performance of it, or, but if it's a super volatile time, it could be cost the same option, same amount of time till expiration, could be trading for $5. And it's uncanny how well priced all of these things are over time.
Market efficiencies, right?
Yeah. Yes, that's amazing. I still marvel at it every day when I see that.
It's astounding. And as I mentioned earlier, an option has a life. You don't just buy an option and it's infinite. It expires, kind of like we do. And some options, when Paul was first trading, there were only monthly options. So they only expired 12 times a year. All right. And then leaps came into the market, and then weeklies came into the market, and now dailies, what we call T plus zero options, came in.
Mm.
And that's got to boggle your mind just in your lifetime to see all these different expirations. And, we went from T3 to T2, T plus one now. It's going to eventually be T0.
Hmm.
And that's going to be supered, folks. But that's the expiration of, when you make a trade, when it takes to clear it. But how do you keep track of all this, the theta of that? Because if you're long, I remember one time when you came home from work, we were on the train, and you said, "Yeah, I got this position on, and I'm just tired of it." I said, "Why are you tired of it?" Because I'm always, 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 always long the option. It's like, well, that seems good. You own it, but I didn't know anything at that time. But
Yeah.
that's because sellers are pushing this stuff on you. So
Yeah.
that's got to be. And are most of the guys in the pit because they're on the other side of people's doing buy rights, right?
Hmm.
Super that too, Josh. Buy right, right?
Yeah. At the time, yes, it was more predictable. You would get that was the play of the public customer. So, but now it's pretty balanced. I mean, and it's so they're so tight and so efficient in most spots. You can look up things that are the 2000th most traded option series, and it's going to have wider markets. But if you get into the SPYs and those types of options, they're penny wide.
Oh,
You
sure, Tesla for
you
sure. Yeah.
you get in there, and the great part is you can get in and out, and you're getting a very fair price. The bad part is it's a really fair price, so you're uh, you
It's
have to
tough
have
for
some.
what you're doing. Yeah, it's tough
Yeah.
for. So here's what makes it even more complicated. I'm just trying to get you guys to understand what this man has done. We talk about expirations, right? Well, there's American options, and those can be called anytime. So if you write an option, they can call it away from you and say, nope, we want the stock, or we're going to put the stock to you. That's where the word put comes from. And then there are European style, which you can only exercise on the day of expiration. And it's not necessarily just in America or just in Europe, so don't worry about that. It's just the style. All right. So when the indices, I don't even know, was the OEX in the 80s? Was that European? Because certainly the SPX is now an XSP, the
No,
minis.
it was not European, and that's actually what probably sunk it, and became a lot less attractive uh, to retail investors and smaller investors, because you would have funky moves after the close, and you could exercise those options uh, and get the cash, own the cash price as it went out, when the market was going to have a huge move the next morning.
Yeah. And for you on your particular side of the market, that's got to be frustrating. You sell a butterfly, super that Josh, and you decide, well, I'm out of the money by 8 cents, but in case something happens overnight, my
I've got
lower
it.
leg protecting me is going to expire worthless, and now all of a sudden I'm short instead of neutral. Oh, and by the way, it's a 300 lot. Uh,
Yeah.
it's really risky. So the
Yeah.
last component, you guys are again, you're watching this later, but Paul and I are wondering maybe what's going to happen with the Federal Reserve tomorrow. Are they going to cut interest rates? So interest rates and options don't really matter if you're trading dailies, as we've talked about, or even weeklies. But if there are companies that need to, or entities that need to hedge with options a year away or 9 months away, RHO comes into play. Talk about calculating that in what you're doing, Paul. If it was a factor, it's probably the least known of the
It was
five. Yeah,
it was the least. Well, in the '80s, it actually was pretty important, because we were having at 10% interest rates. You're really looking.
massive. Obviously,
Yeah.
1978 through even 81, right?
Yeah. I mean, even you know, I just remember most of the time. I mean, they're relatively stable towards once I really got to the point where I was concerned about that. Uh, but yes, that became an issue. Um, it's the risk-free rate of return
Yeah.
uh, of of cash. So everything was, if you own a stock, you're basically paying to have that stock. You're paying that money. Your money's sitting out there. You got to be making at least the risk-free rate of return, or else you're taking risk that's unnecessary.
In futures lingo, it just carry cost. I mean, right?
Yeah. Yes, it's
Okay.
exactly it.
All
So that's that was a big, it was part of the calculation every day. But the change in that was, it's generally relatively small unless you have big balance sheet, which we would. You would get forced in the 80s and the early 90s. You were absorbing all of the people outside the buildings, positions. So in order to square them up, you would have these things called reversals and conversions, which it would be interest rate plays, and you would have these interest rate plays, and you would have, millions of dollars, even back then, of short stock or long stock that you had to pay for, or that you're getting a rebate on, which is, if you're short stock, you get an interest rate when you're a professional. And I actually,
but you also pay the dividend too. If you're a retailer and you're short of stock, you're paying the dividend. Yeah. So here's what's astounding, folks. We've been talking about one option and all the characteristics of it, right? Paul is managing in the pit hundreds of strikes on, I'm trying to remember, was it GE and Sears? And
no, it was Sears. It was a couple different spots. So my career, I changed pits often. My original one was Cigna Insurance, Burlington Northern Railroad, Exxon. Those are the main traders. Moved over to Sears and later and a bunch of other stocks over there. Medtronics, that was an exciting one at that point. And then at Susquehanna, I handled our large order book. From time to time, we had a guy that was. Charles throws out that I'm brilliant. I'm not. The guys that I worked with for the last 15 years would laugh their tails off at that description, because they thought this old guy has never traded before. Because the end of my career was it was really nothing in the trading side.
I remember sitting on the train and seeing you reading books that would have scared Einstein, and you understood what was in there.
Anything for a buck.
I get it. All right. So of these components of the option, I would say the ones, and please correct me, delta is just a given. You can't let your delta get too whacked out, or you're going to have a nice surprise or a bad surprise. You want to pretty much stay delta neutral if you're making markets, but gamma and theta are the two. I mean, obviously vega if surprise happens, but how do you manage gamma if you know you need to unload something? Because as you approach expiration, that option just becomes more and more like a firework. Roman candle transitions from a Roman candle to a Molotov cocktail, right?
Right. And so what you would do is, creating a stock like Exxon, I would put out, sell 5,000 shares of stock every quarter of a dollar for the next $3. And so if the stock just started to run, you'd be selling it, and do the same thing on the way down. You do 5,000, or 2,000, whatever your number of gamma was, up and down. And so that you'd bounce around, and you're basically making a market in the stock around your position. And so you're hoping that you'd bounce into both sides.
And you just had resting orders for that. You weren't, taking an options order and then pointing and saying, sell 5,000, take an option order and sell 5,000. That was just resting when you saw the stock move. You had a broker that would place those trades.
Yeah. Right. You would have a clerk standing next, it's so funny. Like all the people that I stood next to in those pits, I've run into constantly over the next 35 years. And, my first day in the pit, there was a new stock clerk, and she and I, were lifelong friends, and she's still in the business, and she's at one of the exchanges and as a president of the exchange, and she's doing wonderfully. But just funny that when we run into each other, people always ask, how do you know each other so well? And
well, because you go back
on the same day. Um, so I digress. Uh, so I would either tell Patty at the beginning of the day, every quarter of a point, buy and sell 5,000, give her my parameters, and she would have those in there. But if something active was happening, I'd turn to her and say, buy 5,000 shares of stock at the market or at this price.
Mm-hmm.
And we ended up being a very large percentage of the trading in some of these stocks. Exxon Mobil, or as Exxon at the time, and then it became Exxon Mobil, but Exxon at the time, we were probably a third of the volume, the guys in the pit that I stood with, of what traded on the New York Stock Exchange.
Wow, 1/3. And of course, you weren't trading at the Chicago Stock Exchange. You had to trade in New York.
Right. So you get to know the specialist a bit. He knows your profile and your frenemies, and
Sure.
because you're competitors, but they need you, and you end up having, you don't really talk directly to them. I don't think I ever really did, but it would be through our stock clerk who would phone out there and give him your feelings about how he's doing.
Yeah. One of the things on your resume mentions that you're somewhat of an expert in market structure, and that led to future positions. I'm not sure with Ameritrade or post Ameritrade, but maybe tell us about that. You have found a way. I've had multiple careers. And most people watching this that know me started out at a music conservatory and somehow transitioned to this, mostly because of this man right here. When I saw that, it was just the pixel and the V, just rapid change. So, but tell us about market structure and how you use that, because you're a big proponent of education and options too.
Yeah.
So.
Oh, absolutely. So what got me going was knowing that I wasn't as far enough out on the curve to maintain my position in the trade at Susquehanna by being just a trader. So I had to manage, and then I saw an opening because my boss wanted nothing to do with being on any committee for the exchange, and we had a large footprint on the exchange. We had a lot to say about what was going on, and so since I had risen up through the ranks and had a title at that point, it was like, okay, we'd love if you joined all these committees. You're going to have to stay late. You're going to have to do those other things. And I thought it was a great way for me to do something valuable without, because I wasn't going to be that great a trader. And I generally like people. So it was pretty easy for me to do that. So I eventually was on every committee at the CBOE, and then on the board of directors for a few years, and chaired their PAC committee, which was an interesting way to get to meet the people in DC. And then when you're on these committees, you end up meeting the regulators, and it just kind of one thing led to another. And by the time I couldn't take even this part of my life at Susquehanna, I was just done. When I quit, I took that with me. That was one of the things. But I
Sure.
took 2 years off to do pretty much nothing.
So
And
this would have been after the 08-09 crash, right?
yeah, this is it's 2009. I quit in November. I kind of stayed on through the first couple months of 2009. Not going in the office, but kind of I was a representative on too many of the things to just evaporate.
So you were out of the pit though in 05. The crash happened in 08. Obviously,
Yeah,
Lehman Brothers, Bear Stearns would be the start of that. Can you contrast that? This is off script, but can you contrast 1987, October 19th, and how you did then? And you told me many years ago.
Yeah.
And then 2008. We don't need numbers, but what was the difference in those two different panics? Big difference.
Not even close. 87 was, boy, this is really bad day for the stock market, even though it was a bigger move in one day than we'd ever seen. But you felt like it was an air pocket, and people just kind of fell asleep and didn't jump in. His liquidity just wasn't there. In 2008 and 9, it was every day was another shoe to drop, and it was frightening. And it was frightening because some of the clearing firms, you didn't know if Merrill Lynch was really going to make it. they ended up,
Well, Lehman Brothers didn't make it, and when they
yeah,
didn't make it, and Bear Stearns was already gone, um,
you start looking
the
around
Big
and they're all,
Short, right? I mean,
yeah,
you think the movie was pretty accurate? I mean, if
uh,
you can get through the language, I think people ought to watch those or Margin Call. They should watch
yeah,
definitely, even though the language is really strong. Folks, this is real. This is what happened. You were part of that.
yeah.
Tell us about it.
It was really, it was funny. I look now and it was really uncomfortable. Then I didn't have a sense of how big a deal it was, and that's where I really do like Jeff Yaz, who is the managing partner, the majority owner of Susquehanna, an incredibly brilliant guy. And every time we had something that was truly a black swan, or black swan's black swan, like 9/11 and 2008 and 9, Jeff had the right answer immediately. Just immediately.
Isn't that
He
something?
saw 9/11 for what it was, what we grew to learn what it was, and um, he saw what was going on with the clearing firms and the banks, and just knew to duck and cover. And Susquehanna had a lot of money at several different clearing firms, and they just assumed that one of them was going to evaporate, and they ended up being okay.
Can we talk a
But
little bit about credit default swaps? It's important, guys. This is our weeds section. Remember, in the weeds, we got to do this. A dramatic failure on the part of highly paid actuaries. Would you agree?
yep,
Totally misrepresented. They not only misrepresented, they miscalculated the risk in these products. Can you elaborate on that?
yeah. So and honestly, like, I didn't know any of this stuff at the time. I've learned more from the movies than I have and reading about it than I have anything else. And I honestly had no idea how ugly this whole thing was and how close the economy was to truly imploding. What it was is they would package mortgages. All the banks would take on a goes back to actually legislation. Legislation said it was really pushing on mortgage companies to give mortgages to people that had a slightly uh, bumpy past. Their credit was slightly bumpy, and so they would. And the more that they did these, the value of the homes would go up, and so they because there's a greater demand. You had people that couldn't buy homes before that.
Sure.
Now it's, you put nothing down and you get to buy these homes, and you take out a big mortgage, and then
These are the
it's so,
famous viewers. This is the famous liar loans, right? That you're talking about. Yeah.
yes. And so you get all of those, and then you get all these mortgages, and the theory was, well, if you get enough mortgages put together, yes, you're going to have a predictable default rate, and everything's going to be fine. And the more you get to put together, the greater. And I'm sure I'm wrong on some of the nuances of this, but this is how I understand it. The more you get put together, they're going to the raters are going to say, "Hey, this is great. This is from a bunch of different places in the country, but they all had commonality. They all had the 0% down or some aspect of it that." That really made it a ticking time bomb. So what they didn't get was there's correlation uh, amongst these that was significantly different than the correlation of the bonds the mortgages that were written in the 2090s and 80s.
Exactly. For some reason, though, John Paulson did get it.
Mm-hmm.
There were a few
Yeah,
like that. And maybe John Paulson's story.
yeah.
Maybe elaborate on that because I'm sure some listeners are going, "How do you make money when everything's crashing?" Well, John Paulson made billions. All right.
Yeah, so then there would be ways, and what derivatives do nicely is they give everybody a chance to get exactly the risks that they want. And so the banks would sell insurance um, on these tranches of securities, and those um, were, potentially as mispriced as the securities. And so the same people seem to, and this is where I'm way over my knowledge base, it would seem to be the same people. So
Yeah.
it'd be the banks would issue these things, and then they would give you insurance against it. So they it looks like they're offloading the risk, but they're actually through these products they're getting the risk right back on their balance sheets.
Which is
And
exactly what The Big Short was about and margin call. Yeah, they
yeah,
were not at arm's length to do this, and there was no regulator smart enough, except for, and I'm mentioning John Paulson, who's kind of faded into oblivion since that huge move. But some people saw this, and again, were willing to take on the risk of being on the other side of all these banks, similar to Soros in 1993 with the British pound saying, "This is mispriced. You can't take on the Bank of England." I think I can,
yeah,
and that's what the financial
yeah,
markets allow. If you have an opinion,
yeah, yeah, and it was scary because these banks were the same ones that did every other aspect of banking throughout the country and liquidity provision, and that was a scary time. And these things froze up. The the regulators eventually did. In hindsight, it appears that they did exactly what they had to do.
yeah.
Is they wrote these loans and they did it. And I know it's super controversial and there's a lot of scars in people's memories on it. And I can't say that I know that it was right or wrong, but it it worked through the system. The system didn't seize up. We didn't go into a depression, which was
Ben Bernanke and Hank
way
Paulson
closer than
had
I thought
something to
it was.
do with that, though, right? I mean,
Yeah,
this is a case where clearly, had we had a Calvin Coolidge that just said, washing my hands of this, you
yeah,
guys figure it out, it would have been a disaster and could have literally left us open to a financial collapse, which would have weakened us in the world center. Ben Bernanke gets some credit for this, I think.
yeah. From where I sit, that's how I understand it. It's one of those things where I it's such a moral hazard that
Yes.
it's hard to say that it was. I'm such a free market enthusiast. It's hard to look at it and say, "Oh, that was right." It it worked.
It worked
So
and it saved us from a collapse. And more than likely, of course, the limits came in. We had the a limit set in 1987, but they really came into play. Limit down. I think the last limit down we've had that I can remember was when Trump was elected in 2016, and it went limit down, and then they realized, no, that's the wrong side of the market, and it was higher. But we have viewers, we have things in place now. Again, nothing's new except what's been forgotten. And if we forget what's happened in history that could have brought down a financial system, then we're not progressing as humans. But my argument, and I'm sure Paul would agree with me, is that derivatives have played an important part in that, and they have not caused this. They have been an important part of it. So there's a new generation, the Robin Hood. I mean, gosh, look at that stock. Isn't that insane? And that are much younger than you and I are. You're younger than I am, way younger than I am. But still, we have young people coming in. What is the advice that you would give today's option trader that maybe listens to this and says, you know what? I like a financial instrument that's not just up or down, that it can be long 1 month, short another month. I can package them together. There's all these components. I'm kind of a math geek, and maybe this is for me. How would you encourage them, Paul?
I would encourage them to look at all the education offered by every one of the retail brokers. Every one of them has education online that's really good. And it's hard for me to pick because all of my friends are at the retail brokers, from Robinhood to Tasty Trade to Fidelity, to Schwab.
Yeah, I was going to say
These
Schwab.
are
You had your time there. I don't know if you guys realize this, but Schwab is 10.72 trillion as of last week. Sometime I asked my broker there. There's 3 countries in the world that have a higher GDP than that. So, despite what's we've been talking about here, this industry continues to grow and should attract some really good talent. So, what are we? So I see what you're saying. Go to the exchanges, not so much the exchanges, but the actual brokerages house and get information from them. But are they going to be approaching risk management and position sizing? Just simple thing like if you're trading with 100 grand, you're not going to risk 5% of that on a trade. You just can't.
right.
My own
Absolutely.
risk is like 3/8 of 1%, which some people say is really chicken. Well, But there's some pretty big size I can put on in a butterfly or one of these combination trades that, if it goes right, you're risking $1,200, $1,400 to make 9 grand in 2 weeks,
Right.
and those are odds I'll take all day long. Does it happen that often? It happens often enough. It's more repetitive than it would be for a macro trader who's waiting for the next big move in live cattle. So,
Yeah. So there's, and I single these out because I know the people that did the education there. Thinkorswim, awesome, incredible education there, and it's a part of and that's a part of Schwab, and the best even live talking about it, and they do a radio show on all. I think it's on probably all day. Is Tasty Trade, and it's the same guys who built Thinkorswim. When they got out of their non-compete, they built a newer version of it and did a great job. And but they talk about that. They do a lot of talking about sizing of the trades to what your bankroll is.
yeah. The wonderful thing is, again, as opposed to futures traders, and we didn't get into macro at all. Did you ever trade uh, live cattle or palladium or any of that stuff, where you
Um,
can't really size it because you've got these micros now on the financial side and even, natural gas and things like that. But there's still so many contracts, especially foreign contracts, that are full size. You've got a Japanese bond that's, 10,000 yen a handle.
yeah.
So
Um,
with
I
options, though, you can do one lots. I mean, Tony Saliba, famous in Jack
yeah.
Swager's book, Mr. One Lot Trader, right? So
Mhm.
it's
Yeah.
an easier way to learn. Expand on that if you would.
Yeah, I mean that's how you learn. You have to get into liquid instruments that uh, that give you a chance to get out and get out when anytime, no matter what the liquid, anything outside of a black swan, you can get out anytime at a reasonable price. You may not like the price because it's not a price that you were hoping that it would be, but that to me is such an important aspect of it. You trade small, trade often, and you will learn. And the
Right.
only way to learn is you have to have money on it.
Yeah.
I know this
Paper
sounds old.
trading. Let's just both diss paper
Yeah.
trading right now. Do a one lot in P&G, folks. You've got $500. One strike handles. All right. You
Yeah.
have to have real money on the line. And if you want to cheer being up 30 cents on the day, that's fine. When you have more confidence in a bigger account, then you can move on. You cannot do that buying stocks, even on a 50% margin where you can't trade on margin if you only have $500. But you can do all kinds of things with options that you cannot do with these other markets. So,
And if you looked at, I actually don't trade very often now. I have uh, I have concentrated positions that I'll at times either write some calls against or buy some protection or buy a put spread or something like that. Uh, but I uh, when I trade, I watch it all day, and my positions are so small at times that it's laughable, compared to what's in the account, and it's because I get nervous about it. I don't really love to, to have the sweat on so much anymore, but sometimes you feel compelled because you have this, I have positions that I've had on for 15, 20 years that you can't sell out of because of capital gains.
right, they have to go to the next generation. We have the same thing here. And these are, I've talked to you guys about this. If your clients, about non-qualified accounts versus IRAs. If Paul were trading this at an IRA, it wouldn't be an issue, but because it's a non-qual account, it is. So let's look back at this career as we kind of wind down here. So between your college education, the Pitts and the SIBO, Susquehanna, Ameritrade, board member at Chicago Board Options Exchange, right?
Mm-hmm.
What
And
what
correct.
has Go ahead.
Well, no. So then it went for. I mean, I've had another stop after that that actually was very important and a blast. It was Ameritrade. I got picked up. I got approached by some folks at IMC, which is at the time very small firm. When I got into Susquehanna, there was 100 people, and I left, and there was about 1,800.
Wow.
17 years later, I got to IMC. I think our employee count was about 160 in Chicago and 400 worldwide. I'm guessing our Chicago population is probably 700 10 years later. And worldwide, it's, I think, on the annual report, it says right around 2,000.
So you grew all these companies in
Yeah.
addition to
So yeah,
everything else.
it was all my genius. So what happened was they wanted to start a, a business that traded that handled the trades of the retail brokers. So uh, the way options work, uh, none of the retail brokers actually hook up directly to the exchanges. They go through an intermediary like uh, it was, uh, Citadel, Susquehanna, now IMC. Used to be the banks. Used to have Citigroup in there, and Morgan Stanley just left the business, and some others are still coming in. And when you handle those trades, you get the advantages of having a chance to trade against those more often. But it's a really fair, like, it's, that sounds bad. So um, it's not. I mean, you're on the markets or better than the markets. You're better than markets like 80% of the time, and better than what's being displayed. So everybody kind of wins to it, other than and so IMC wanted to build that business. IMC had super young employees. I was the oldest guy by at least 15 years, other than a few of the technologists. And I for 10 years I helped build that up. My side job there, on top of that, was to run market structure,
Okay.
and represent IMC in all of the committees, the industry committees, and I also, and still do, sit on the board of the Miami Exchange, which reportedly is going
I was going to
public.
say, yeah,
Yeah,
going public and really coming along. Well, and do you think Ken Griffin had anything to do with that moving Citadel to Miami? Maybe just a little bit,
yeah.
huh?
And so Miami Exchange has been great, fantastic people. And I've been on their board for 9 years. So I'm excited to see if and when the IPO comes.
Gives you tax deduction to fly down to Miami, MIA,
Yeah,
and
yeah.
land and talk. If you could have had one single piece of advice 35 years ago that you didn't get, what would that one piece of advice been that would have made your career better or stronger?
Um, you know, I feel like every twist and turn gave me so much, and I listened to my mentors, and I think, hang out with smart people like that, and that's really what happened. And classy people. Susquehanna people were
And
unbelievable.
passionate, can I throw that in? I mean,
Yeah,
you mentioned that, the people that you were in the pits with were just passionate about doing it. That
yeah.
helps. You want to do something. And that's kind of a advice you give somebody. If you want to be an options trader, you better be passionate about it, because it's going to hurt if you're not.
Well, because everybody else is. Like, you're not going to keep up unless you're passionate about it.
Correct.
I have to throw this one in. Like, what I did before I traded every day was, and it wasn't every single day, but it probably averaged 3.5 times a week, was I would run the same 6 mile route that I ran every morning. And I threw up on the front lawn more than once trying to beat my times. So it's just, you have that competitive drive that you want to beat yourself as bad as you want to beat everybody else, and just get better. And that's what helped. I look back on it, and it was just, my parents ingrained that in us, and I think that did help quite a bit. And the people that did it better, there are people that did it better, and they're just more passionate.
Well, we need to have competitiveness like that. So, is there a story or stories as we finish here that you
Mhm.
want to share, that will motivate a different, younger generation to want to pursue this field of derivatives that we both love so much? What would you tell them?
I would say if you have any inkling that it doesn't sound well, first challenge yourself. So you have to be. It's going to be challenging every day, and you have to know it's challenging, and you have to go to work or pursue it like it's a job because everybody else understands it, and to get on the same plane as everybody else, take your time and do it small and tiptoe into it. And suddenly you wake up one day and you're a lot further into it than you ever imagined you'd get.
And I would add, and never want to turn around and go back.
Oh, I don't either. That's why the U.S. like anything you would change. It's like, yeah, I made a lot of mistakes, but I learned something. Like,
Yeah.
and now I can say I learned something from them. Um, if I were rational, I never would have quit at Susquehanna. If I were, rational, but I ended up with a great run at TD Ameritrade, and then, an amazing group of people that I met and became part of at IMC.
Well, in our next interview, which will not be a third of a century from now, we're going to dig into some of these stories. But I've waited a long time to do what I'm going to do right now. Those of you that know me, family, friends, and clients, have heard me say the phrase on my show. I've said this when I used to give speeches live. I would say something and talk about how I got started and say the words, "Thank you, Paul Jiganti." This is a time that I actually get to say it to the person himself for taking me on the train that day and going through the turnstiles. I was just like Don Knotts on Andy Griffith. My eyes were so big, and standing me there and saying, just watch, just watch. And I said, well, what's this guy doing? That guy just made 10 grand. Well, what about this guy over here? That guy just lost 3 grand. It's like in seconds. Oh, less than that. Mm-hmm. And I just went home bewildered, and it started me on a trajectory. I didn't give up music, but I realized this was going to change my life. So I want to say on this show, as we conclude, to you, my friend, thank you, Paul Jiganti, for what you did.
Charles, this was a pleasure. I just gave you a taste, and you did this all yourself. And I am humbled by what you have done, and I think that it's just amazing how you put all this together. And the true genius is doing this on your own like that. So
a lot of bumps on the road, but
you learn a lot.
I think that if you don't hear anything else, folks, from this interview, both of us have a passion. We've taken different courses. He had an economics degree. My degree's from a music conservatory. But just so you know, so was Alan Greenspan's. You guys know, watching this, undergrad from Juilliard. He toured with Benny Goodman and then went on to be chairman of the Federal Reserve. So you can have any kind of background and do this. There were athletes, as Paul said, that were on the field, in the pits. Find something that you really like about this, industry, and pursue it with a passion like both of us did. And you'll be successful too. I hope you got something out of this. Thanks for watching. Tune into the next time, and we'll see you then.
Thanks so much.
Thank you, Paul. So there you have it. Paul and I literally had not spoken until this interview for a third of a century, as I mentioned in the interview. 33 years, time flies. But Paul has had a really interesting career. I hope you guys enjoyed hearing about that. I hope you heard the passion in his voice still at his age. He's younger than I am, but I have the same passion that I first garnered when he took me down on the floor. I absolutely love the markets. I love the derivative markets too, but the stock market, the bond market, the way that we can create wealth by investing in America and around the world, but in particular in America. And the exchanges in this country that started in New York and Chicago and now have expanded to Miami and Philadelphia, Cincinnati, on and on and on. But I hope that you learned from this. I hope you found it enjoyable. We'll do more of these. And I say thank you to all of you that watch this program, because you are my audience. And without you, there's no point in doing any of this. I say thank you to those people who worked for me in our businesses over the years. I say thank you to my family and friends who have been supportive to me as we have built this business and what we're doing. But tonight I said, thank you, Paul Jiganti, for the start you gave me so many years ago. Thanks for watching.